Hello, and welcome to Manage Your Money, a financial literacy program. This is to talk about what you need to be doing for your business as well as for yourself in being able to manage how your money comes in and how your money goes out, and then tracking that process. My name is Brenda Bryant. I am an instructor here at UNR Extension, and these presentations are for you. So let's talk a little bit about something you've probably been talking about a lot, which is debt. So what is debt? And that's one of the things that we're going to talk about, understanding what it is and what it isn't. Because once you get your arms wrapped around understanding what debt is, that's your first step in understanding how to manage your money. So let's look at debt and credit. Debt being money that you owe. So that makes sense, because if you owe somebody something, that is a debt you owe. That is money that you owe. What is credit? Credit is the ability to borrow money. So what is that based on? And we're going to get deeper into this as we go along. So we want to know why credit is so important and why debt is seen so negative. When we're looking at credit, or when someone else is looking at maybe letting us borrow money from them, they're going to be looking at our credit rating. So we're going to talk a little bit about what is a credit rating and what impact does that have. Once you get money from someone else that you have to repay, you are now in debt. So debtors are people who go out and borrow money that they have to pay back. So what you got was not a gift and it was not a grant. It was money that you borrowed with the caveat that it must be paid back. Where do you get this money from? Well, you get this money from creditors and lenders who loan money, and the caveat is still the same, that you must pay it back. When you are looking at whether you want to become a debtor, that you want to borrow someone else's money in order to get done what you need to get done, there is a philosophy of using OPM, which is other people's money. What you need to be thinking about as a business owner is, how much money do I need? What do I need it for? Do I have the capacity to pay it back with the terms that the creditor has given me? It's going to be over a certain amount of years. It's going to have a certain finance rate or interest rate that has to be paid back. Remember, interest is that is the price of money. So interest is going to tell you, can you afford to borrow X amount of dollars at Y interest rates? And you have to think this through, because you have to look at not only what you're doing today, but if we're talking about a debt that is over several years, what do you see happening in your business, and what are the things that you're going to do in your business that allow you then to have the capacity to pay this money back? So what do you need to know? Okay, so when you're looking at your money and you're looking at how your money works in your business and the effects of borrowing money from somebody, you want to know, well, who did you borrow it from? Who do you owe this money to? How much do you owe them? Okay, so again, these are things that you want to think about before you sign on the dotted line. How much are the payments? Can I afford a $500 a month payment, or can I afford a $750 a month payment? When are the payments due? So looking at your cycle of how your money comes in, when does the majority of your money come in? And should your payments be due at a different time, does that cause stress within your business? Other things that you want to think about are, what's the purpose of this money I'm borrowing? Is it for a real specific need within the business, or is it something that I saw and I thought, this would probably be a good idea? But is it a good idea right now in the situation that you're in? So when you're looking at borrowing money, you want to ask yourself a lot of questions, because the lender is going to be asking you questions also. So people get into debt for a lot of different reasons. Maybe it's something that you're purchasing that the company needs. So you're buying an asset. Did you buy a building, a physical location? Did you buy a vehicle? Did you buy a piece of equipment? Did you buy computers? Did you bring on new employees, etc.? So looking at what it is that the business needs. You're also going to be looking at the bills that you pay, or maybe that you don't pay. And this is a reason that people get into debt. They get into a situation where the bills that are coming in cannot be handled by the revenue that's coming in. So are you covering unexpected emergencies or expenses? And they do happen. And so we're going to talk about setting up some kind of an emergency fund, some kind of a contingency fund, something that a reserve fund, whatever you want to call it. We need to have some money set aside, because it's not if this happens, but it's when this happens, and it will happen. And did you buy something that you wanted, or did you buy something that you needed? And go back to the first question, did you have the money to pay for the purchase of that item? If you did not have the money, did you borrow the money from someplace? Was it through a credit card? Was it through a loan, etc.? Did you have the money to pay that back? So it's always that balance between what I need to purchase, what I want to purchase, and what I can actually afford to pay for. So how does debt work? Well, for some people, it just seems like it's so complicated. And there's so much that's attached to it. And for other people, I just go ask somebody for some money, I pay for this, and eventually I'll get that paid back. What you want to think about is, first of all, what is it that you're buying? Secondly, what impact does that purchase have on your business? Because if I'm buying a piece of equipment, and the impact that that equipment has on my business is that I can now bid larger jobs, or it is replacing a piece of equipment that didn't work, or I have an additional piece of equipment that now allows me to get work done better, faster, etc. That's one consideration. But did I buy this, or did I go into debt for something that I wanted? I want a new truck for the business. Now, the one I have is working okay and we keep it in maintenance and that's working fine. But I saw this really cool truck and it looks really spiffy and it would make us stand out as a company. And I would really like to buy that. Again, what do you have to do? You have to think this through. Is the new truck worth the amount of money that you're going to have to pay for it? And do you have a strategy, a game plan, a goal, a projection on how that money is going to be paid back? So let's look at different kinds of ways that we can get other people's money. There is something called a secured loan, and that's a loan that has some collateral attached to it. Okay, so, and what is collateral? Collateral is something that you have as the borrower that could be exchanged for cash if you aren't able to repay your loan according to the agreement. And so that cash, that whatever that collateral is that you have, would take that cash to go against that loan. For instance, I am looking at getting a loan for my business. I need a piece of equipment I would like to have, and I'm talking to a lender. And the lender is saying to me, we can offer you X amount of dollars. We can lend you X amount of dollars. Our problem is that we don't have the ability to do that unless we have some collateral that will back it up. So do you have a home? Oh, well, that would be collateral if there is enough money that has been put into that house that actually belongs to you versus not just the price of the house. Do you have an automobile? Do you have money in the bank? So what kind of collateral can you bring to the table? And you may have heard this term before. Can you put some skin in the game? And skin in the game just means that the lender's looking at, hey, I can give you X amount of dollars, but you know what? You have to bring something to the table too. And that's a secured loan, that there is something that is there that you have within your business, and in many cases within your personal, that would say, if this loan is not paid according to our loan agreement, then we can go take this thing, this collateral, and use that to help pay off our loan. Be very clear when you're looking at secured loans to find out what it is that's needed and when may that pop up. So principal is the money that you decided to borrow. So let's say, for instance, you decided to borrow money to buy a building for your business. And so the building costs $500,000. $500,000 is the amount of money that you want to borrow, but that's only the principal, because there will also be interest attached to that. Because remember, interest is what the borrower is selling you. Okay, that's the fee that you pay the borrower in order to use the borrower's money, or you use OPM, other people's money. It's also going to be any additional fees. So that $500,000 that you want to buy the building, that's principal only. And then when you add all these other things too, it's going to be much more than $5,000. And again, you need to be thinking about, what impact does that have? Do I have the revenue coming in that I can take care of that, etc.? Interest is the cost of borrowing money. Interest is the fee that you pay the lender in order to use the lender's money. And revolving credit. Now, this is probably something that you're pretty much aware of because you've used this before, especially if you've had a credit card or if you've had a line of credit through your bank or through your lending institution. So a credit agreement that allows you to borrow money from time to time up to an amount. So let's say you have a line of credit for your business and your line of credit is $10,000. You can borrow up to $10,000. As you pay that back, the payment gets added in so that, let's say that your limit is $10,000. You have borrowed or you have used $5,000 of that. As you pay that $5,000 back, so you've made a payment of $1,000 for principal, then you now have $6,000 that you are able to use as credit that you can borrow against. But remember, that is only the principal. That does not include the interest, and that does not include the fees that go along with that. Your interest is attached to what you have borrowed. It's attached to the money that is still outstanding that you owe. So if I owe $4,000 against that $10,000 revolving credit, the interest is going to be attached to that $4,000 because I still owe that. If I pay that $4,000 off and I'm now back to my original agreement, which was the limit was $10,000, if there is nothing sitting out there that I have borrowed against, then there is no interest that is attached to that. This is one of the reasons with credit cards that you hear people say, well, you want to pay your credit card off in full because I'm going to borrow X amount of dollars this month, but when that statement comes at the end of the month, I'm going to pay it off in full. If I pay it off in full, there is no interest that is attached to it because there is no balance to it. My balance is zero. My amount that I can use has gone back up to its full amount. So just make sure that you understand with revolving credit, what that interest means, what that interest is attached to, and you have to decide how you want to pay this off. There are some philosophies that say you always pay the total amount when it comes in. There are other philosophies that say you always leave a little bit on your, I'll use a credit card as an example. You always leave a little bit on your credit card, knowing that that little bit that you leave is going to have interest attached to it. That's definitely something that you have to think about. Look at against what your revenue is coming in. What can you afford to pay? What impact is that going to have on that thing that we hear a lot about these days called your credit score? So we're going to look at, and I know you've seen this before, your APR, your annual percentage rate, and it's the total cost of you using somebody else's money, and it's calculated on a yearly basis. So when you look at this, you're looking at, as we talked about before, we're looking at the principal, the interest, and the fees, not just the principal by itself. And then we're looking at the term of the loan. So let's say that you're buying this building for $500,000 and the term of the loan is 30 years. So you're going to have a balance on this for 30 years that interest is going to go against that balance. Every time you make a payment, only a portion of it goes toward principal because another portion goes toward interest and goes toward fees. When you're looking at your APR, you're going to take that information, you're going to take that time to 365 days, okay? And you're going to get that percentage because you multiply that by 100. So you will see that you have an interest rate and you will also have an annual percentage rate. So what is an installment loan? An installment loan is when you borrow a specific amount of money and you repay it over a certain period of time. So I have an installment loan for $5,000. I am going to pay that loan over a year. And so then I have, according to the agreement, I have a certain amount that is due every month so that by the end of that year, that loan is paid off. Now, one question is, can I pay this loan off ahead of time? And the answer is, read your agreement. There are some agreements that say it's not a problem if you want to pay it off ahead of time. There's no additional fees or interest that's attached to it. There are other agreements that say there is a penalty, and that is what it's called. There is a penalty to pay off your loan ahead of time. Now, why would a lender give you a penalty for paying off a loan ahead of time? Because remember, interest is the fee that is charged to use someone else's money. So maybe if you pay it off ahead of time, they get the principal back, but they don't get the fee that's attached to it because that fee is attached to the balance. So make sure that you read and understand any agreements before you sign them. Because once you sign them, you look back and go, well, I didn't really think that it meant that, or I didn't understand that. It's too late. You already signed it. So what is an unsecured loan? So an unsecured loan is a loan that does not attach itself to your collateral. So for instance, now we'll go back to a credit card because that's probably the easiest example. The credit card is an unsecured loan. It doesn't say that in order to have this credit card, you need to bring something to the table that says that if this agreement doesn't work out between the two of us, I can go and I can sell your house or I can sell your car, etc. So an unsecured loan says, okay, I've looked at all the things that I needed to look at. I'm feeling comfortable as the lender that you are a good risk. And a good risk for a lender is someone who has a background that says, I borrow money and I pay money back. I don't have late payments. I pay things on time. Sometimes I may even pay them ahead of time. But I've got that. I'm constantly paying back what I've borrowed. And I haven't caused a problem for me or for the lender. So when you talk about a loan with no collateral, there is no attachment to something you already have. So what are installment loans? Okay, so we're looking at what's principal. Okay, principal is the amount that you borrow. So if I'm buying that $500,000 building, the amount that I'm borrowing is that $500,000. The term of my agreement says how long that I have to pay how long do I have so that I can repay that principal, but also that interest. So I'm looking at, and you may have seen these before, something called an amortization schedule. And an amortization schedule tells me what is my principal, what is my interest, and what is my length of time that I have. So if I'm buying this $500,000 building and I have 30 years to pay it off, that's my length of time. That is my term. But every time I make a payment, maybe time I make a payment to the loan, you will notice that when the loan gets started, most of the money goes toward the interest and not toward the principal. There are times that, depending on how much the loan is and how long the loan is, sometimes you are almost to the end of the loan before you even get to halfway through. So if you buy a building and you say it's a 30-year loan, you may not get to half of my building has been paid for until you're in year 20, 21, or 22. Because those payments before that, most of that went toward paying the lender the fee, which is the interest that the lender has said needs to be paid. So the lender gets paid first, and then the building gets paid. And then your payment is the same amount, usually every month, and that's called a fixed loan. So my payment is $5,000 a month, period. That $5,000, part of it's going to be principal, part of it's going to be interest. How will I know the difference? Because I'm going to read my statement, but you can't just say, oh, certain percent's going to go toward principal and a certain percent's going to go toward interest, because that consistently changes as you pay off your loan. So what the largest amount of your payment at the beginning of your loan, excuse me, went toward your interest. Toward the end of your loan, the largest amount will be going towards your principal. If you have a variable or an adjustable rate payment, you're constantly going to be looking at that to see, has the interest changed? And if the interest has changed, then the amount going toward principal and the amount going toward the interest will also change. So revolving credit, back to looking at a credit card, revolving credit tells you this is how much you can have. So let's say you just got a credit card and your credit card limit is $5,000. That's the most that you can borrow, or the most you can use that credit card against at one time. And then your payment's going to be based on what have you used. So if I spent $100 of that $5,000 limit that I have, then my payment is going to be based on that $100 that is outstanding. And credit card companies and other lenders have a minimum payment. Usually it's between 1% and 5% of whatever that outstanding balance is. I personally recommend that whenever you have a balance, if you can, pay off as much of it as you can. Because if you're paying minimum only, that's going to stretch out the amount of time that you have a balance. And the longer that you have a balance, the more interest that is attached to it, because the interest is going to be attached to the balance. So if I can get that balance paid off as soon as possible, then that means that I can stop having that interest being attached to the balance because it's paid. So, you want to think about paying more, you want to think about paying it off sooner, and you want to think in terms of, let me get away from that interest that's attached to that balance. So what are fees? Oh, these are the things that we just love that just pop up and go, oh, by the way, you still owe this too, don't you? So these are additional charges, but it's not interest. So you have three things that you're dealing with when you're making this payment. You're dealing with the principal, you're dealing with the interest, and you're dealing with the fees. Okay. And so you need to understand what the fees are. You need to know what's going to be charged to you, what you are responsible for. If there is a change in something, are you going to be charged something different? So bottom line, in any negotiation that you're looking at, read the agreements very carefully. If you don't know how to read the agreement, pay the money to have it reviewed by somebody who does, preferably an attorney, so that you know what's being covered and you're not going to be blindsided by, oh my gosh, I didn't understand that fee did this, that, or the other. So repayment is something that many of us look at and go, yes, 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 I want to get this thing paid off as soon as possible. But again, read that agreement. So early repayment of all or part of a loan is going to reduce those interest costs. That's what we've been talking about. And it may mean that you get an earlier payoff date. Okay, again, read the agreement. Ask if there are any fees for repayment. And remember, we talked about the fact that there sometimes is an early payment penalty. And that penalty is, wait a minute, now you're paying us off faster than we expected. We, the lenders, actually want the interest that's going to come with that. So maybe the agreement says if you pay this off early, you still owe us all this interest. Or maybe the agreement says if you pay this off early, there are no additional charges. Read the agreement and understand it before you sign it. So where can you go for help when you're trying to figure out all this debt stuff and trying to figure out what money's coming into your business, what money's going out of your business, how do you manage that money as best you can? There are nonprofit credit counseling organizations, and they mostly work with personal. But it never hurts to ask a question if you're having an issue like this in your business. You can also go to USA.gov and you can search for credit counseling. One of the things that you've probably seen a lot of advertisements for people who are saying, and they're not talking about businesses as a whole, but they're just talking about people in debt in general. Hey, we'll be very happy to help you get rid of that debt. We'll be happy to clean up your credit rating and etc. Again, read that agreement, because what they're telling you that you can do, maybe that's something that you can do on your own and not have to pay them for their service. Or maybe you decide, I don't have the time and I don't want to take the time to learn all of this to do what needs to be done. Paying them the money is worth my time. You have to think this through and you have to decide what works best for you. The Federal Trade Commission is always talking to you about finding and choosing a credit counselor that is really going to be able to help you in your situation. Debt in and of itself is not a bad thing. Unmanaged debt is a very bad thing. So this is why you want to read, ask questions, understand as much as you can, because once you sign the piece of paper, you are now obligated. So choose your help carefully. There are debt settlement companies, as I said before, and they do charge because they are in their companies and they're in business. There are debt consolidation loans. There are people who have used debt consolidation loans and it has worked out well for them. They take all of that stuff that they owe, it goes into one loan, they have one payment. But you have to look at that the same way that you look at any other debt. How much revenue is coming in? Can you cover that payment? What happens if there's an emergency or a contingency? So anytime you are paying somebody else for the use of their money, you want to be very, very calculated and focused on what you're doing, because it needs to be a win-win situation, a win for the debtor and the win for the lender. So we went through that. That was a lot of stuff, okay? And hopefully it's going to be helpful to you as you're going through and looking at debt, looking at making payments, what payments mean, making sure those agreements are fully read and understood. So we have a virtual classroom, and in that virtual classroom, we have classes that are in English and in Spanish. The virtual classroom is open to anyone who would like the information, so please feel free to go there and pick the classes that you feel are going to help you as you move forward. If you are not a member of Nevada SBDC, which stands for Small Business Development Center, I would recommend that you reach out to them. And as you reach out to them, you're going to click on this red button here that says Request Advising, and it's going to take you to this page. And this page says, go to New Client Sign Up. And in New Client Sign Up, just put in your information. And what will happen is that you will be assigned an advisor, and that advisor and you are going to sit down and discuss where you are in your business, or if you're just starting out in your business, where are you now? Have you gotten your license? Do you have any employees? Do you, etc. So where are you? And then where is it that you want to go? You know, do you want to conquer the block, or do you want to conquer the world? And so once you know where you are, your starting point, and you know where you want to go, that's your ending point, then you and the advisor are going to build out that strategy to get you from where you are to where you want to be. The best way to use your advisor is to ask questions and be very honest about where you are in your business. It is not to talk to the advisor as if to say, this is where I would like to be, but let's talk about where you actually are so we can get you to where you would like to be. So I'd highly recommend that you take the time to go to the virtual classroom, also go to the Nevada Small Business Development Center. And thank you very much. I appreciate your time and your effort in going through this class on understanding how to manage your money and managing debt. My name is Brenda Bryant. I am with UNR Extension, and our purpose here is to serve you. Thank you.